Hey guys, right now it is 1:15 March 28, 2025, and today is the CoreWeave IPO. I want to tell you guys if this is a go or a no. Alright, first off, what does CoreWeave do? Basically, they buy a whole bunch of NVIDIA GPUs, then they lease out a data center or something somewhere. They put the GPUs in, and then they rent out extra capacity to companies like Microsoft, Facebook. But in the future, I do see an opportunity for other companies or smaller scale companies or governments that might want to test out AI infrastructure without, buying hundreds and thousands of GPUs themselves. So it's kind of like a temporary stopgap for companies to dabble their toes into creating their own AI without necessarily investing in the infrastructure itself. Now the problem comes is that they own hundreds, if not thousands, of NVIDIA H100 GPUs and A100 GPUs. Meanwhile, NVIDIA is coming out with like new GPUs every year. I think we're already on H300 in 2020, 25, 26-ish. Problem with that is that their GPUs are going to be rapidly undervalued soon because of the accelerated depreciation of the tech alone. All right, let's go and look at the fundamentals. All right, guys, we are back and we're kind of just going to walk over what is this? The S1. We're going to walk over the S1 forms, the pre-IPO, the prospective, so to speak, of CoreWeave and see if this is a good company to buy or you should probably skip this one. Do keep in mind that the environment, just the overall market conditions for this IPO is kind of choppy. We're in choppy markets right now. I think they might have grabbed the last spot to IPO, but the valuation will be heavily impacted by the current market conditions. All right, let's hop in and see what they got for us. 2024 revenue, $1.9 billion. 23 to 24 revenue growth. I'm thinking this number is a bit skeptical because they were a Ethereum mining company before they switched over to AI, and we're kind of still in like the first inning of AI. So this number might slow down a bit, but I do expect this revenue number to go up as more companies like Meta and Microsoft needs more capacity to train. Or you could say that the training phase is over, and then these companies have their own capacity, like Meta and Microsoft have their own capacity to train their own models, so they don't really need CoreWeave anymore. All right, 17% operating income margin. Let me. So this number represents after everything is taken out, including people's like, the rent, SG&A, everything else is taken out. It's gonna be around 17%. Not bad, not that good either. All right, 24, whatever, adjusted. $15.1 billion in 2024 remaining performance obligations. I'm assuming this means that Microsoft or Meta platforms sign on for 5 years and they only recognize part of the profit in the first year. So they still have, this is how much they have in accounts receivable, kind of. Pretty good, $15.1 billion, pretty good. And this is how much power they bought from the nuclear plants or whatever we have now. How many GPUs we have? Wow, 250,000 GPUs across 32 data centers. Pretty impressive. All right, this is kind of reading the propaganda, so to speak. I'm gonna count it by nature, so I have no idea what this this stuff means, but maybe get a guy who does this stuff for a living to explain it to you. Operating at AI hyperscale. All right, so right here is saying that is like a exponential gain per GPUs that they're gonna have, and I'm guessing they're trying to say that revenue is kind of accelerating. That number might be a little bit fudged though, to be honest. Um, Remaining performance. Okay, they're just repeating what they said again. Yeah. So they're saying roughly around their average contract length has 4 years left in it, and they roughly have like 15 billion left in their accounts receivables. That doesn't mean, you know, they could just sign new contracts and stuff, but right now this is what they have in the bank, and I'm guessing they're kind of pushing this narrative to get you to buy. All right, this is all their, you know, special terms and all their fancy corporate jargon. All right, this keeps going down. I'm trying to find their freaking profit and loss. All right, this one's kind of cool where their data centers are located. It's mostly in the U.S., which is, you know, with Trump being in office and, you know, tariffs every other minute and whatnot. This might be good. This might be an advantage here. And most of the world's AI powerhouses, Google and Amazon and all that stuff, are located here, but they do have a few in Europe. So just in case the European players come along, these data centers might be a lot more useful. Leaving out the blank, which kind of sucks, but all right, there we go. Here we are, the numbers. Year ended in 2022. This was when in 23 and 20. All right, let's just, whoa. All right, for sake of easier comparison, let's just put their numbers as like as is, because, you know, you got add some zeros. So this is like 15 million. This is, you know, 228 million. This is like in a 1.9 billion, I'm assuming. But for the sake of comparison, let's just leave it as is. All right. All right. So as you see, the revenue year over year over the last 3 years is increasing exponentially. But from here, I think they were a Ethereum mining company. Then they moved to AI training. Then they moved to this. As you can see, it is increasingly in like a upwards, you know, parabolic moves, as the big guys will say. And I think their last, what is that, 493 divided by 1915. I would say their gross profit margin is around 25%. No, wait. Cost of technology. Cost of revenue, technology. Why would they split it out like that? That's kind of weird. Alright, you gotta do like 960 plus 493 divided by 1915. 25%. All right, the gross profit margin is somewhere around 25%. Keep in mind, Nvidia is around 70%. So they're kind of operating further downstream of Nvidia. So their profit margin is going to be a bit lower, a lot lower, 3 times lower actually. That's not looking too hot. I would rather be Nvidia, the guys making the chips, than the guys who buy the chips and then sell it to other. I don't know. It kind of. I think they're just operating on flex capacity of this. Can they charge higher rates? Not really sure. It depends on how the contracts are written, to be honest. Okay, sales and marketing, general administrative. All right. Operating income loss, fair value adjustments. Ooh, this probably comes. This is $750 million in fair value adjustments. What the fuck are they adjusting that cost them 750? Is this how, like, you know how when you have like older chips and then the value of the chips fall? Is that how much you're taking? That's a lot. That's almost $1 billion of just fair value adjustments right here. Oof. All right, this is just the interest right here. They did take out a lot of debt. I believe somewhere. This is how much you're gonna be paying in interest every year. It's around 360. So it looks like around 7-8% of that other net income. Wow. All right, so they're not profitable. They are losing money, but most of it comes from, all right, most of their expenses come from technology infrastructure lines. This line right here. I'm I'm guessing that's where their data center leases and stuff are located. So they do rent or lease their data centers, which is the actual building that holds their GPUs. So I'm guessing that's where that falls in. This is a very capital intensive business. I'm not sure I'm going to be buying this. Consolidated balance sheet data. Cash and cash equivalents. I'm guessing this is in the billions. So they have a billion, working capital of 3 billion. Why is this negative though? Alright, so the quick ratio is not bad. The cash and cash equivalents is higher than their current debt. I don't think they have any current debt. It's just a bunch of non-current debt. Alright, this is their adjusted EBITDA, net loss margin. It is decreasing. Interesting how it's decreasing though. Alright, so just from the financial statements alone, this is a very high risk company. Just from their positioning in the market and their cost structure versus their revenue structure, this is kind of that good of a company to be in, especially if we have a recession or companies like Meta, Microsoft just don't need extra capacity anymore. Then they'll be holding GPUs that are rapidly depreciating on their hands. I guess that would be like the bear case. Kind of have a whole bunch of GPUs that they gotta pretty much on a 24/7 basis to get as much revenue out of them as possible before they rapidly depreciate within 4 years from now. Well, probably they only have like 1 or 2 years left before you move on to the H500s or whatever Nvidia comes out with. This is a very market determinant company, I guess. It's like if people need GPUs ASAP, they need to scale in, this company will be very successful because then you could charge more. But then if they don't, then they're kind of fucked. They'll be holding a bunch of GPUs, and then their debt servicing and all that stuff is gonna take over. What is this? Key milestones. And then even if they do make revenue, would they need to keep buying new GPUs every year to keep up with the demand? It's like endless capex cycle. Every year just like keep buying more and more GPUs. So will they ever make money? Alright, this is how their debt structure looks like. They paying somewhere around $332 million in debt. Interest, just the interest portion every year. Taxes, revenue. Okay, so you can rapidly scale and meet evolving needs, but that means you're just sitting on a pile of GPUs that may or may not go used. Maybe there might be an opportunity here for them to buy up all the old GPUs that companies like Microsoft and stuff like they upgrade to the new H200 ones, and then they could sit on like a bunch of old GPUs and just use that for extra capacity, and just run that for Microsoft and Meta platforms. Okay. Our technology and infrastructure expense. Since the year ended, this increase is attributed to an increase in depreciation and amortization of approximately 90 million. 11 million for the year ended, driven by investments in a platform. Okay, so some of that expense comes from the rapid, depreciation of like server racks and wires and switches and modems and routers, and I don't know what they use. Increase by 10 million compared to increase of approximately and personnel costs. Okay, so they're investing into sales, which kind of interesting. Maybe they plow into that and then they get more sales in the future. That is interesting. The year increased by 24 million or 397%. Year ended this year increase of by 16 million in personnel, which includes headcount growth support. All right, so they're hiring more people to upkeep these services. Lost on fair value adjustments. That is huge, considering the size of the company. 531 million. This increase was driven by an increase in the valuation of derivatives and warrants tied to our common stock and redeemable. Oh, okay. Alright, so I'm guessing it's not, kind of meaningful, but it's like one of the losses. Somebody sold some warrants and stock convertibles a few years ago, and then the valuation of the company goes up. So now they got to pay out a higher amount, which is coming back to bite them in the ass. But it's more of like an equity, like an expense thing. So I was wrong earlier. This is kind of good news for us, more like paper loss or paper gains. Sure, they need to pay them out, but they're paying them in shares. So, yeah. Imagine you go to Domino's, you buy like a option small pizza, then when you're walking there to pick it up or something, the pizza is like expanding. You still get a slice, but it's now worth more. So is everyone else's. So it's not like bad. It's not like the price have increased or they threw off like a topping. This is kind of good. Increased by higher. So they're borrowing more money. That's not good nor bad because they are using the money to expand operations. So overall, would I buy this company? That's a tough question. That's a toughie. Would I buy this? I'll maybe open a very small position, maybe 1 to 2% of your portfolio here. See where it kind of goes, especially with this choppy market going on. Got to be careful with where you deploy your capital into this choppy market. But I could see where this company is going, but I can also see where it might not go due to the recent markets, and you're just basically you're predicting the demand for NVIDIA chips and how hot it's running. If it's running super hot, then this company is a buy. A no-brainer. Close your eyes and just buy. But then even if it cools just like a little bit, it cools to the point of where the AI models like DeepSeek are getting more efficient, or it cools to where Microsoft and Meta platforms can just use their own chips, or if other companies can just AI becomes much cheaper and everyone could just buy their own chips, then this company is pretty much going to go kaploots. Or maybe as more people just uses AI, they could just use this as a backup thing. Have companies have backups, backup data storing or something. So in case your AI model, your servers go down, these guys could be your backup. So that's another viable path for them to go. I'll give it a B ranking. I wouldn't be a huge part of your portfolio, but sure throw 1 or 2% of your portfolio in there. Decent buy. Good impact for NVIDIA though. If NVIDIA just buys them out and then maybe can just manufacture GPUs for themselves and just throw it in there, and then they should rent out GPUs for cheaps. It might be a really strong model actually. That's my final thoughts. If you have the money, throw in 1 or 2% of your money into this and see what happens. That's all. Signing out.